Hi everyone, hope you're all doing well, and today I'm talking about the free UK stocks to buy September 2021 edition. Now I am going to let you into a little bit of a secret. This is actually my second time recording this video. I recorded this video and then I went to go edit it and then I realised the microphone's not working. So yes, this is my second time recording the full video, and this video was supposed to be up yesterday, but because of that microphone not working, basically meant there was no video because I didn't have time to re-record it and edit it. So yeah, sometimes you don't see what goes wrong behind the scenes, but that was one of the things that went wrong yesterday. But anyway, getting on to free UK stocks to buy September 2021 edition. These are the free UK stocks that I'm most likely to buy in the month of September. I, at the moment, have not bought these. There's a few reasons why, and when I go into the companies, I'll say the reasons why I have not bought them exactly yet, but I am keeping, these are the free stocks that I'm keeping the closest eye on at the moment, and I do find them very interesting. And yeah, I'll say why I'm finding them interesting and also what I'm kind of looking for before I do pull the trigger on them. But these are definitely three interesting companies that I thought I would share the information with you guys. So I hope it is useful, and if it is, hit that like button. And if you do want to join the Patreon, the link is in the description. On there I post my buy and sell alerts, so if I do end up going to buy any of these companies in the month of September, they will be on there. And also there's 600 members on the Discord to talk to, and also there's 2 exclusive videos a week, sometimes free. And if you do want to start investing, there's some links to some brokers in the description like Free Trade. Now, one of the cautious reasons why I'm not buying at the moment is the FTSE is kind of having a bit of a downturn at the moment. There is a little bit of uncertainty around if there's going to be another lockdown in October, and also because schools are going back, is there going to be spiking cases? And I think that's getting priced in a little bit, and that uncertainty might mean stocks go lower, in my opinion, through the month of September. And also financially at the moment, you've probably seen it out there in the news, national insurance has been hiked up, and also the one that probably affects us investors a little bit more, which doesn't really get mentioned in the news, is there's going to be a dividend tax hike. So if you're buying a lot of shares probably outside of your ISA, that might affect you a little bit and you go over your dividend license. A little bit annoying, especially when it was a manifesto that promised that got broken. And as well as that, you'd think, why are they kind of increasing it when they just made this big red bus saying that if we left the EU, that 350 million a week would go to the NHS. But enough of that, I'm not going to get too political. Just, it's very strange to see someone or the PM telling another lie. You would never think that, but hey, anyway, enough of that. We'll get stuck into stocks because that's what we're here for. And number one is In the Style Group, or In Style Group. So this is a new stock on the stock market and it has caught my eye, and I'm very, very interested into this company. It came onto the stock market on March the 15th. Since it came onto the stock market on March the 15th, it's had a pretty bumpy ride after its IPO, and you can see here it's down 16% at the moment. Now, I don't tend to buy IPOs when they happen just because they tend to be quite high valuations, there tends to be a lot of hype. I normally wait 9 months, and as well as that, normally get the lockup period as well, and in that time I just track them, and if they fall off the cliff a little bit after the IPO, I consider buying them, and I've done that quite often with quite a few companies, and this is the latest one that I'm seeing that IPO'd in March time. We're getting towards 9 months down the line now, and since its IPO, it's fallen off the cliff a little bit, and that's the first thing that got me interested. Now, I actually heard about this company last week because of their earnings. I had a look at their earnings, never heard of this company before, had a look at it, had a look at the earnings, and I was really blown away. So when we get onto the earnings in a second, you'll see why the numbers were so impressive to me. But yeah, it was on the stock market at £2.37, it's now £1.99. It's currently a 104 million market cap company, so it is quite a small company, take that into consideration. Probably not the best platform to buy in this on is trading 212 because of the liquidity. It is profitable at 167p. Now that probably will seem very high, but it does say it's a profitable company. The reason why it does look quite high, which I'll show you in a second when we get onto the financials, is just because it's just got to profit. So that P will probably drop down a lot quicker. But when you look at the growth and to see it's profitable, it's actually really good. So I'm just going to put that down there. But if you don't know what In the Style is, and I didn't know what this brand was actually until I had a look at it, and it does seem very popular, it's got good reviews. In the Style is a e-commerce clothing company, and the difference that In Style has is they collaborate with influencers. So if I go on the website here and go on collaborations, you can see all the collaborations they currently have with a lot of influencers. This is one of the newest ones that they've just launched, and what they do is they get the influencer, they design the clothes with them, they do obviously all the photography with them, and rather than paying for marketing through like Facebook and Instagram, they kind of partner up with the influencer. And the big thing about that is obviously the influencer gets quite involved in it. They share it through their platform of people they've already built up on social media platforms, and they get kind of direct sales, and obviously they see them kind of wearing all the clothing as well. And I just really like the partnership they kind of have going on here with a lot of these influencers, and as they build them up, I think it'd be quite huge, because every time you kind of get a new influencer, it's a total different market. It might bring in some new buyers into the site. So I do really like the pairing up with a lot of influencers here. It does make it slightly different in a very competitive space. And the first thing that after looking at this, what kind of reminded me of massively was, I don't know if some of you guys know this company. If you're a bit of an OG, you've been around the channel for maybe a year, 2 years, you probably know this one. If you're kind of new, you probably won't know about this investment. But yeah, a while ago in 2019, I started buying into a company called Revolve, which is a US company, and they did something very similar with influencers and using influencers to promote their products. And once again, involved in clothing, what they did is they IPO'd, which you can see here. IPO'd, and then it fell off a cliff. Obviously down here is the CV, but even before the CV, after the IPO, it was down 50%. And that's one thing that I've not really bought this one just yet, is that in case it does go a bit further after the IPO. But it had that drop off in the IPO. I was tracking it, thought it was a great company. Ended up buying it around here, and yeah, it was one of my best performers in 2020. I ended up selling it for about 100% gain, but as you can see, I probably should have held it a bit longer. But the point being is that this reminds me a lot of Revolve at the moment, which was a very similar company through the pricing and how the company works, and you can see how well that did. And if you've been on the channel for a while, you'll know how well that one did. Some of you might have even invested into it as well. So yeah, it got a lot of Revolve feels from this one at the moment. Now, what really got me excited about this company, and when I heard about this company, was because of its earnings. I kind of thought, I've never heard of this company, went on to the investor relations, went on the recent earnings, went, wow, some really, really good numbers here. Now, if you look at the numbers here, you can see from a year here, they've gone 132% in revenue growth to 44 million, and also gross profits growing at 101% as well. So 132% gain in revenue and 101% gain in gross profit. Now, the big thing to remember with this one is that obviously it's an e-commerce site. What has happened to e-commerce over the last 12 months? Obviously, a lot of them have had a major boom, and that's one of the things that I'm kind of being cautious of here, is that has this just had a very good 1 year because of the CV, or is this still going to put in fantastic growth in the next kind of 2 to 5 years? Because if it does, it comes very interesting. That's the little challenge here, that I'm very unsure whether or not to purchase now or just kind of leave it a little bit just to make sure that they can still grow at a very good rate. And that's the one thing, and one of the other reasons why I've not exactly pulled the trigger on this one yet. But as you can see here, the numbers they're putting in a fantastic amount of growth. Direct to customer growth 108%, wholesale growth 353%. You can see that they also improved their conversion rate, and also the average order value increased by 10%. So the amount the orders are coming to are going up, which is great, and also the amount of people that are coming back and ordering more often is up as well, which is a really, really positive sign. It kind of says that you've got a very good company here. They also have launched some new influencers collections, which is great, and also they have a new partnership launch with Asda to sell in 100 Asda stores. So that's very interesting that they're looking to go down there. Obviously, there's more than 100 Asda stores out there, so that could be more scope to open up in more stores. Also, potentially, are they looking for more potential partnerships down the line if the Asda one's big? So you could kind of see this like third-party wholesaler coming a bit bigger in the company and growing a huge amount in the next few years as well, which you can also see already that it's starting to put in some decent bits of revenue for them. So I think that's very important to kind of watch what develops with this company a bit further down the line. And my big worry about is that can they keep up this revenue growth? If we look here on the outlook, you can see that sales in the first quarter of the financial year 2022 financial year are up 44% ahead of the prior year. So at the moment, my question about can they carry on growing is a little bit answered here. It looks like it. If they can carry on growing at 44%, that is really impressive, because when I bought Revolve, they were kind of growing at like 30%. So this would actually be even better financials than Revolve, which is scary. So yeah, if they could do that, that'd be very impressive going forward. Now, going back onto sales, as you can see, that's 44 million. If we just flick across to Simply Wall Street here, you can see it's 113 million market cap. So that actually puts it around about a 2.5 price to sales ratio, which is dirt cheap, because if you normally have a company that is profitable, has an amazing balance sheet and grows at a say a 40, maybe not even a 40 or a 30%, you're probably looking at a company that's around about 10 to 15. So that's incredibly cheap. And then also, the P is a little bit high, but it's just got to profit as well. And sometimes when you have like a profitable growth company like that, the valuation they can trade at is normally pretty good. Not normally this valuation as well, which is really interesting. Now, if we go on to future growth, there's only one analyst at the moment covering it. That's how new it is, and they only cover the revenue. They don't even cover the earnings on the company. They're kind of expecting that the growth isn't the same. They're expecting about a 30% revenue growth. Obviously, there's no profit there. When we go on to the past performance of the company, by the way, this company was only made in 2013 as well, which is very impressive. You can see here the growth that they had was very impressive here. The only little concern you'll see is they went from like a high 20% growth here, and then what you'll see here is 2019 the revenue growth was only around about low 10% range. So yeah, you can see here that there's a big difference. This is the big worry that I have with buying into this company, and why I haven't exactly pulled the trigger just yet, is if this company goes back to this sort of growth where it grows 10%, then obviously it's not going to trade at such a higher valuation. The thing is, if they do this, where they grow 100% or even 40%, then they are going to trade at a big valuation. And that's the only little question I have over the company now, is what's the revenue growth going to be? Because the valuation difference between if it grows at 10% to 30 or 40% is a massive amount of difference here. So that's the only thing that I'm kind of considering on, and that's why I'm not pulled the trigger yet. But obviously, if you start talking this company puts in 30-40% growth, which it looks like it could do, then this is a steal at these sort of prices, and that's why I'm really interested in it. Financial health wise, like I say, you've got a profitable company, revenue growth amazing, and it's very healthy. Assets to liabilities very strong. Debt, it's paid all its debt off. Obviously the IPO has helped a huge amount. Debt to equity is 0 as well. You look at the balance sheet, it's got 11 million in cash, so for a 100 million company, 10 million in cash is very healthy, a good amount of cash, and obviously it's got no debt as well, which is great. Management, this founder is Adam Frisby. He's been there since obviously the founder, so he's been there for 7 years. And also the great thing about him being the founder and being there is if we go into the insider ownership, you can see here he actually owns 23% of the company as well, and he's the biggest shareholder, CEO and founder, which is also really positive to see a founder-led company with plenty of skin in the game as well. And to take this company to where it is in 7 years is pretty good going. So as you can tell, this company is very good profit-wise, ownership-wise, financial health, revenue growth. The big question is this e-commerce boom, is the CV, has it helped it do numbers that it can't continue to grow every year? And that's the little difference I have. I'm kind of debating whether or not to buy now or wait to earnings to see if it can still put very good growth in. Because if you can put 35% revenue growth in at this sort of valuation, it's an absolute steal. And that's just a little debate that I have at the moment. So I am kind of considering that one. And this one actually ties in with number 2. And number 2 is ASOS. So these two are very similar companies because obviously they are e-commerce platforms and they sell clothing. So they're very, very similar. And obviously for me as well, I'm kind of debating, do I buy in the style? Do I buy ASOS? And also I've got to consider I have Boohoo, and I want to be very careful that I still keep a very diversified portfolio. And this is kind of why I'm kind of not buying anything yet, because I'm still in the decision phase of which one do I kind of buy on this list. But ASOS is one that is very much tempting me at the moment. The reason why is the share price has fallen off a cliff since March. If we go on March, you can see here, this is roughly where the 52-week highs are. You look down here, it's fallen 43%. That's a massive drop. For your company to lose that much value in under 6 months, nearly half of your valuation, is a massive, massive drop. You've gone from a 6 billion company nearly down to a 3 billion company now. Massive sell-off. And I'm not going to lie, I didn't even realise this little sell-off had happened recently since Friday as well. I didn't realise it had gone down another 5% this week. Now, obviously there was it had been downtrending for a little bit, and then there was some negative earnings that sent it down, and then since earnings it tried putting a little bit of a recovery in, but boom, it's fallen down even lower. And at this point I was very tempted to buy ASOS, and I was weighing up about, can I own Boohoo and ASOS? I was thinking about it, and I was just a little bit unsure. Now the valuations has given me, another nearly 10-14% drop in the share price. I'm just finding it really hard not to buy this one. It is very, very tempting. Now at the moment it is trading around about a 19p ratio. This is okay if it was an average company, but when we get into the financials, you'll see ASOS is not an average company. It's got very good growth, a very good balance sheet, good profit, good revenue growth, and to trade at a 19p ratio is probably not fair for a company like this as well. Now, like I said, if you don't know what ASOS is it's an e-commerce site for clothing, and as well as just having its own brands, it also has other brands that do sell on the site as well, which makes it very much different from, say, a Boohoo or In The Style. And I think because of that, it does apply to a lot of different age ranges. And why it's also been able to stay really popular for so long is because if one brand goes out of fashion, ASOS can just bring in the brand that is in fashion and it will do very well. So I do really like the website. I've used it myself, and yeah, I still think that ASOS will be around for a few years yet. And if we go into the recent financials, what you'll see here is that in the recent financials, very good. So you'll see that they grew at 31% revenue growth. There's not too much about profit here because they have made a few investments, which we'll talk about in a second. But you'll see here the numbers are still very strong. 31% revenue growth. Got to consider they might not be able to do that all the time. Probably the CV boom has helped them a little bit. But even if they still grow at like a 20% revenue growth, to trade at that P ratio is very, very cheap. So you've got to take that into consideration. But even so, if you take one, maybe a worst case scenario here, does the valuation kind of make sense with the growth it has? Probably not. And that growth is pretty good. Now, if you do go further down into their recent trading update, you'll see they actually announced a new partnership. The new partnership was with Nordstrom. You might have heard about that US retailer before. And also they have made investments. They made investments into Topshop, Topman and Miss Selfridge, which you might have seen on the news recently. Obviously, a few of the high street brands have struggled and they decided to buy these brands. Personally, for me, I did think that ASOS did overpay for them. However, in the long term, I think they will be good additions to the ASOS site. Now, finally, what caused the drop in ASOS? It was this line in the earnings report, which said the final weeks of June saw a softening due to the impact of consumer demand, continuing CV uncertainty and unseasonal weather. Now, first of all, unseasonal weather for me, I thought was just a load of rubbish. For me, I thought June, July was actually probably the two best months of the summer. August I thought was a bit gloomy, but I thought to blame it on the weather was a bit unfair. I remember the 25 and 30 Celsius days were in June and July, so I'm not sure on that one. However, the first bit, the uncertainty of CV does kind of make sense, because when we consider there was supposed to be Freedom Day in June and then it got knocked back to July, then basically 4 weeks was people kind of not thinking, do I need to buy any clothes? Am I going to be going out? Is that party going to happen? Are we going to go on a night out or anything like that? So I can kind of see there might be a little bit of softening from that point of view. The only little two worries that I do have with this statement is ASOS said this, but when Boohoo did their update, they didn't seem to say much from Boohoo's point of view about a softening. And also when we talk about a company a little bit earlier, In The Style, obviously they had no mention of a softening as well. So it does kind of seem maybe it's just ASOS. And the big other thing is, when you see softening, there's not really any financials there. It's not like we saw a percentage of slowdown. That word softening creates a lot of uncertainty because you don't know how much that is, and that's the worst thing for stocks, is to come out and cause uncertainty. You cause uncertainty, you make investors very nervous. You can see the impact on the share price. They made investors nervous. That's why it's lost 50% of their share price in kind of the last kind of 3 billion. Why they've lost 50% of their share price since March, because of that uncertainty. And that's what I'm kind of thinking of as well, is like, you don't know. If the thing is if we go into earnings and it turns out in earnings it's a bigger softening than we thought, maybe you think, oh, they're still going to grow 10%. But what happens if softening actually meant sales are decreasing 20%? Because if you start thinking that, then the share price isn't going to go up, it's going to be going down even more. And that's why I'm kind of thinking, do I wait for an earnings update or do I buy a bit, and then if it happens average in? And that's what I'm kind of undecided on, as well as considering the Boohoo point of view for my portfolio, and also In The Style I'm considering as well. And a little bit of an example of what happened previously with the share price in ASOS is in 2019, ASOS had a shocking year. Their share price fell off a cliff and they just had problem after problem. And this is the thing, is you just got to be careful that you don't this is only the top of the iceberg. It could get a lot worse from here. And in 2019, they had 2 profit warnings. The IT side of it was an absolute failure. The warehouse was an absolute mess. And because of that, if you go on the share price in 2019, you'll see the big massive drop here off in share price since then. It lost 67% of your value. Now, do I think ASOS is going to have a problem like that? No, 2019 was multiple problems. whereas this is just a little bit of a soft sale. So I don't think it'll be as bad as that, but it's just something you got to be careful of. Is, you know, you don't realize, is this the start of something big where this softening is actually ASOS struggling for sales? And that's the other part of it that I'm being very careful of at the moment, and where I've not decided on it. But just going on to the financials, just to be a little bit more positive about the company, you'll be able to see here past performance. The company has done very well: 1.4 billion, 1.9 billion, 2.5 billion, 3 billion, all the way up to 3.6 billion. So you can see the average kind of revenue growth on this is 20%, which would make sense. If this carries on growing at 20%, you know, this company's pretty much a steal at this sort of valuation. Profit's a bit in and out, but it has grown historically. The reason why it's a bit in and out is because of the investments that they have made, which I never mind. I'm always happy with that. Assets, liabilities in short term a little bit level, long term okay though. Debt to equity, it had some debt in 2019 or 2020. It's paid it all off, which is good. So it has a very strong balance sheet from that point of view. The cash balance is a little low. For a company like this, I'd probably want it to have about 300 million in cash, minimum 200 million. So that could be a little bit better, but at the same time, it has been buying a lot of companies at the moment, so I will let it off a little bit. Going into the ownership of the company, there's been more people selling rather than buying. The only little suspicious thing in here is before the share price drop, you can see here 14th of June, you can see here the CEO actually sold a ton of shares. Not very suspicious at all, is it? And going into the inside ownership, the biggest shareholder in the company, as you can see here, is the co-founder, who is a non-executive director, who is one of the biggest shareholders, but that's the inside holding in the company. So yeah, overall, ASOS is number 2. I am really considering that one because of the massive dip. To lose 50% in 6 months is what you would think a bit of an overreaction. The only little thing that's holding back is the uncertainty, and then also deciding for my portfolio, you know, I've obviously got Boohoo, I'm liking in the style, I'm liking ASOS, don't want to have too many e-commerce brands that sell clothing. So yeah, I'd love to hear you guys in the comments, you know, even if you don't really like the companies or invest in the companies, any one in particular that you like the most, or if you were to have one in your portfolio, which one would it be? I'd love to hear you guys in the comments and your thoughts on it. But we'll get on to number 3. And of course, number 3 had to be Hollywood Bowl. It's been making this monthly series quite a bit at the moment. It is probably my favourite company in on the UK scene, even though it is not my biggest UK holding. Obviously, my biggest UK holding is S4 Capital, but the amount of times I do think about making Hollywood Bowl my number 1 positions, yeah, it is a lot. Now, if you don't know what Hollywood Bowl is, I thought the name would give it away, but it is obviously a bowling alley. But as well as just having bowling alley, they do have now a mini golf. They also do the arcade, and they also have a bar as well. So they have a lot of diverse incomes coming in now, which I really do like about the company. So they do select these in very good locations, like at leisure parks, for example, and even if you don't go bowling, it will be tied around like a cinema or a restaurant. So even if you don't want to go bowling, if you might go to like a Nando's, for example, you might pass Hollywood Bowl and go, oh, should we just nip into the arcade, or shall we just go get a quick drink? So the location selection, and now because of the multiple incomes they have, I do really like about that. And when they do expand the amount of locations they have as well, I think will then also add into profit and revenue. Now, what I like about Hollywood Bowl is they've put really impressive financials in, even though they've hardly been open. So this is one of the companies that's been hit most by the pandemic. There is obviously the clubs that are being shut for most of it, but the next ones are leisure centres. Leisure centres like bowling alleys, like ice skating, have pretty much been shut all the time. The only time they have been allowed to open since March 2020 is pretty much October, and then from November they were shut again, and then from Freedom Day basically they were back open again. So there's so many months that they've been shut, and even in them months they were still putting in very good growth. And you'll see here profitable trading after the first lockdown with solid performance in October. Now, you consider back then in October, you know, you had to go out, you still had to wear masks, there was a lot of social distancing, there was some places where the locations had gaps between the bowling lanes, arcades were shut, the bars had restrictions. It just wasn't a great time to be operating. Nowadays it's getting a little bit more relaxed, and because of that, people will be more happy to go out. Obviously there's not many people have gone abroad recently, staycations and everything, people looking for things to do, so I think that would also help it. And the big thing as well is, like, it went into, actually before the CV, actual January and February were very strong months for this company, with it still growing like 10%. So because of that and how good it was, it would have had a very good 2020, a record 2020, if it wasn't for the CV situation as well. And because of the location's doing very well, it has about 60 venues at the moment. Its new plans to have overall target doubled to 14 to 80 new centres by 2024. So when you've got 60 venues and then you potentially go into 74, 78 venues, obviously what's going to happen, that's going to increase profit and revenue further down the line, and obviously that's going to help share price as well. And when you go look at the company's past performance, you can see this revenue growth here and the profit growth as well. Obviously that would have been even a record, if we had 2020, it would have been going even higher if it wasn't for the CV. And then you think about the new venues that will come in, obviously that revenue and profit will still go up in the long term. Financially, it's still very strong even after being shut for pretty much a year and a half. Asset to liability is still very good. Debt to equity is still sitting around 31%, which I'm happy with. And you'll see the debt here, 28 million. And if you look at the cash here, 37 million, that's all still very good. It did used to pay a dividend. I don't know if it will come back to paying a dividend. I don't know if it will focus down on paying debt. I don't know if it will just go, you know what, we'll just spend that money in expanding, going into new venues. If it wanted to do either of them rather than paying the dividend, I would not mind. I would be happy with that decision. Now, what's very interesting on the ownership front is a lot of the people that work inside Hollywood Bowl, they bought a lot of shares when the CV dip happened. After that, 6 or 9 months ago, they got a lot of criticism because a lot of them then sold the shares, and people were panicking a little bit. But not many people talk about this again, is that what happened recently is a lot of them have come back in and bought more shares in the company, which is very positive, because last time they did that, obviously the share price did very well. And the people that buying the shares are pretty much everyone that you would want. The CEO's buying a lot of shares, the CFO's buying a lot of shares, the chairman's buying a lot of shares. Very good from the inside point of view. And I guess the only little downside is that when you do look into the ownership of the company, there's not too many insiders that do own shares, but they are buying, which is a really positive sign. You do have to go down here until you find the CEO, which owns 1.86% of the company. But still, I think it's okay, because when you look at what they're doing, there's so many people buying in shares. I think it just gives you that bit more confidence, even if there isn't a big shareholder in this one. So number 3 is Bol. I did last month average up on this one. I was up about 50% and I averaged up, and I could consider buying some more shares. I think the new, because we haven't had any proper financials out of this one for about a year and a half, when we do get around to some proper financials, which I believe is October time, I think people will actually go, wow, look at Hollywood Bowl. But really, when you look at the performance they had in the 1 month they had in October and what they did pre-CV, it won't be that much of a surprise to me. I think obviously the numbers will be very good, especially when you put in the expansion plans as well. So I am considering buying more Hollywood Bowl, because I do feel like when it comes around to the first proper earnings, where they've had a couple of good months being open up, people will be really surprised about how good the numbers are. And I think it's a very good company with a good diverse income as well, which I do really like. So number 3 is Hollywood Bowl. I don't know if I will buy that one exactly, because I did buy some more shares last month, but you never know. The big thing that might happen with this one is because of this fear of a potential October lockdown, because of schools going back in the UK, if cases spike, obviously the big risk that it is to this one is it is a leisure company. When you think about if there's a lockdown or if they look to kind of close a few things, what are the first things they're going to probably close? It's going to be a lot of the leisure places, and that will be Hollywood Bowl, and it will be back shut again. And that uncertainty might just lead to the share price in September being a little bit rough for this one. And if that happens, that's where I probably would buy, and that's why it's on this list right now, because if that happens, I would end up probably buying that one. So hope the video was useful. If it was, hit the like button. If you're new, subscribe, and I will see you on the next video.